Weekly options decay 3 times faster than monthlies in their final days. But that speed creates a specific risk called gamma risk that wipes out most new traders. When choosing between weekly and monthly expiration cycles, you are fundamentally trading speed for stability. Most beginners gravitate toward weeklies for the rapid results, but they fail to account for the structural disadvantages. We need to break down the mechanics before placing a trade. First, let's define the contenders. Monthly options are the standard contracts expiring on the third Friday of every month. Weeklies are short-term contracts listed to expire on every other Friday, providing 52 opportunities a year. The primary reason traders sell weeklies is theta, or time decay. Option decay is not linear. It accelerates as expiration approaches. A weekly option is essentially born on the steepest part of this decay curve. Because of this curve, selling a weekly option allows you to realize profit much faster than a monthly. You don't have to wait 45 days to capture the premium. However, there is a mathematical price you pay for this speed. That price is gamma risk. Gamma measures how fast your delta changes when the stock price moves. Weekly options have massive gamma, meaning a small move in the stock price can turn a winning trade into a massive loser in minutes. Think of gamma as the sensitivity of your steering wheel. Monthly options drive like a cruise ship. It takes a long time to turn, giving you time to react. Weekly options drive like a Formula One car. One wrong twitch at high speed results in a crash. This difference dictates your management style. Monthly options allow for adjustments. If a trade goes against you, you have weeks to roll the position or wait for a rebound. Weeklies often force you to take a loss because there is no time to recover. Another hidden factor is liquidity. Monthly contracts usually have tighter bid-ask spreads because institutions trade them. Weeklies can have wider spreads, meaning you lose more money to slippage every time you enter or exit. So, when should you use weeklies? They are superior for binary events like earnings plays or economic data releases. You use them when you want exposure to a specific moment in time without paying for weeks of extra time value. Conversely, monthly options are the gold standard for income strategies like iron condors or covered calls. The 30 to 45-day window is the sweet spot where decay is decent, but stability is high enough to sleep at night. Let's look at the premium capture comparison. If you sell 4 weekly options sequentially, you might collect more total premium than 1 monthly option. But you also take on gap risk for separate times over the weekend. That extra 30% premium in weeklies isn't free money. It's compensation for taking on 4 times the weekend risk. One bad gap opening on a Monday can wipe out months of small weekly gains. Let's structure a decision flow for your next trade. This logic helps remove the emotion from choosing an expiration date. If you aren't doing a quick directional flip, you need to assess your management time. If you can't watch the screen all day, weeklies are dangerous. For buyers, the logic flips. Buying weeklies is cheaper in absolute dollars, offering higher leverage. If you expect a massive move in 3 days, buying a monthly is a waste of capital. Weeklies maximize the percentage return on explosive moves. However, buying weeklies has a low probability of profit. If the stock stays flat for just 2 days, the option can lose 50% of its value due to that aggressive theta curve we saw earlier. To summarize the trade-off, monthlies offer defense through slower gamma and easier adjustments. Weeklies offer offense through rapid decay or high leverage, but with zero room for error. A balanced approach for many traders is to use monthlies for their core positions, selling puts or covered calls, and use weeklies for small, speculative bets with money they can afford to lose. Final warning: never sell weekly options during earnings unless you specifically intend to gamble. The volatility crush can be lucrative, but the price movement often exceeds the expected move, resulting in immediate maximum loss. Choose your expiration based on your strategy, not just your patience. If you want income, buy time. If you want action, buy speed. But understand that speed kills accounts without proper risk management. Choose monthlies for management, weeklies for speculation. Trade safe.